Um, so let me see. I think Karthik, you had your hand up first, maybe.
Thank you for an excellent walkthrough of the Coca-Cola journey. It was really lucid and clear. Much appreciated.
Of
Two quick
course.
questions. I guess one question around that, and it's a specific question, but it's a more general underlying question, which is your point about scratching your head. Why did Buffett purchase additional shares of Coke in 1994 when the earnings yield was about 6%, compared to his usual benchmark of 9 to 10%? And I could flip that question around more generally to say he was sitting on a 300% or 400% gain at that time. Why did he not sell? And that's the broader question for me. When you buy at an attractive price, the multiple expands. An investing question as important as when to buy is when to sell. And it's interesting to me, why not sell? And perhaps the journey from 94 to 97 was the most explosive stock growth that followed in
Yeah.
Coke afterwards. So that's my question in a nutshell. And I know there are multiple factors. The return on equity was great. The bond yield was 6%, but it still was like, why not take the gain and find alternative investments which had better earnings yield
Yeah.
rather than sit on that? So,
Yeah. Well, one of the things that I think is pretty interesting is that Buffett actually did say I think like, he didn't say it in 2000, but somebody asked him after 2000, like, because I think in 2000, Coca-Cola went to like something like 50 times earnings or something like that. Like, and Buffett admits that he made a mistake. He said he should have sold Coca-Cola, right? I think if I had to guess, I suspect it was a little bit of he didn't sell because he didn't need the money, right? He didn't, he probably didn't have something else to put it into. Um, for all of if you look historically, Buffett hates to pay taxes. Um, so when you look at sometimes when he's structured deals and done other things, he's done them in ways where he doesn't, he tries to avoid paying taxes or not paying taxes as much as he might otherwise have to. So he looks at it and he had probably a large capital gains tax that he probably didn't want to pay. And then I think Buffett has there's a little bit of a reputational thing, right? Because he I don't know if at that time he had said it, but he said at subsequent times he said that this is one of our permanent holdings. So if he says that it's a permanent holding and then he goes and sells it, does it make it harder for him to buy other companies, especially companies that he's trying to buy outright and things like that? So we don't know. Again, like I said, I think one of the things that Buffett, I think, looks at is all these, all those sorts of things. And, I think also at that point, he probably already felt like his personal reputation and legacy was already pretty intact. And so, he could do a little bit better, maybe if he sold it and bought something else. But, you know, Berkshire Hathaway by that point had already done so well that I don't know how much it would have really kind of changed his long-term performance. But it's a very good question. One thing I will
yeah.
say,
And
one thing
sorry
I'll
if I may just add to the question,
yeah,
and I don't want an answer right now, but maybe interesting to look at 1994 deep dive like you did for 87, because really the stock had its most explosive growth 94 to 97 still. So maybe he saw something there, even though the earnings yield was low, that made him say, I should hold on for a period of time.
yeah, yeah,
Speculation.
could be the case. Um, like I said, the only thing that stood out to me was literally the fact that he bought exactly 100 million shares. So he was at like 90 some odd million shares, and he bought that last little slug. You know, I think he just wanted a nice round number, but I don't know. It's a good question. Buffett's still around. So if anyone of you guys ever get a chance to ask him, maybe you can ask him that question in person. Um, MD, I see your hand is up.
Yes. I see that you separated the net income from the business, like compared to all other income, and try to get the yield for the yield on the equity. So that's what we need to do for everything. Every business we see that it has, say, the business part, operating business part, then investment part, then other income. So we need to do every time like that.
I think for these kinds of businesses, the answer is yes, right? Like if you think about like, if you think about like a company like, I don't know, take one of the big tech companies, take Google, for instance, right? I don't even know. Google has like what, $100 billion of cash that it's sitting on, right? Now they do probably want to have some amount of cash to run the business, right? But Google probably doesn't need $100 billion of cash, right? Or Apple or any of these companies. And so really, when you think about those businesses, you should really think about it as two sorts of things that you're buying. You're buying an operating business and a pile of cash. Right now, tomorrow the company could decide to pay a big dividend and dividend out all its cash to shareholders, right? Or they could just decide to keep it. But you know, that cash still belongs to you. And either the company will use it, or hopefully at some point they will distribute it out. But you should get some value. You should think about it as having some value, right? I mean, Berkshire Hathaway is a good example of this exact thing, right? They have their operating businesses, right? They have the insurance company, they have the railroad, they have the utility, but they also have a giant portfolio of stocks, right? So you can look at Berkshire Hathaway as really being two pieces, right? A stock portfolio that you could buy a portion of, and an operating business. And so you really need to think about what those two things are worth together and add it up.
And do you do all the time all this opportunity analysis like this way, like this thorough? Because I see you have done really good thorough analysis, and then you're making decision. We need to go through like that.
Well, I mean, it depends. Not every company is like this, right? Because not every company has a bunch of non-core investments, that are part of its business, right? A lot of businesses are just the business, right? And they don't have like a lot of excess cash or something like that, right? I mean, you can think about like, I don't know, Costco or Walmart or something like that, right? They don't have like, you know, ancillary investments and like sitting on like a lot of extra cash or something like that. In which case you just need to value the business itself. But then you might have some companies that are, the complete opposite. All they do is just own pieces of other investments. And so they're just a portfolio of investments. And so then you have to go and value what the investments are worth. And there's maybe not much of an operating business. And in Coca-Cola's case, it was kind of a little bit of a hybrid where it was mostly an operating business, but they did have some significant non-core assets. And so you have to really kind of look at the value of those non-core assets as well. And in Coca-Cola's case, it was also they had actually gone and IPO'd, majority stakes, right? So there was not just that, they owned 49% of Coca-Cola Enterprises, but you could go and you could see what the per share price was of Coca-Cola Enterprises. So every day you could look at what Coca-Cola's ownership in Coca-Cola Enterprises or TCC or Columbia Pictures was worth and kind of make the adjustments and then see what the core business was worth.
Because I see that you have gone through all their projects they were taking in the history for the growth. At the same time, you're going through the capital structure, how they change to reduce their cost of capital. At the same time, you have seen how their dividend and repurchase policy. That means you have gone through the whole circle of the business and you have seen all aspect of the business. We need to look through this when we go for the investment.
Well, I mean, I would say, you know, it really is very company specific, right? A lot of companies don't change. What's interesting about Coca-Cola in a lot of ways is it was a really poorly run business for a long time. And I think one of the reasons why, someone like Buffett waited until 87 to invest or 88 to invest is really because, when you looked at it, they were actually kind of becoming this conglomerate and, kind of diluting the core soft drinks business, which is the great crown jewel business. And it really wasn't until 86 when they spun off the bottlers and 87 when they announced the spinoff of Columbia Pictures that they really kind of showed you that they were refocusing on what was the core, you know, s- crown jewel business, right? Um, but some companies change a lot, right? And some companies don't change very much, right? So if a company has gone through a lot of change, then yeah, I think it's probably worth studying and understanding why they did something and why they changed direction. And a lot of companies are the same company they were, many, many years ago. They just keep doing the same thing. So I think it very much depends upon um, you know, specific circumstances.
And
Charles, I see your hand up.
Yeah, thanks, Jay.
Yeah.
The purpose is regarding to the purchase price. You said it's earning yield, 10% of earning yield. So basically earning yield is PE, right? Reverse of the PE. 10% earning yield is like a 10 PE.
Well, no. He's first of all, he says a 10% pre-tax earnings yield, right? He says 6.5 to 7% after-tax earnings yield. So 6.5 to 7% is what, like 14, 15, something like that times earnings.
Okay, 6.5%. So yeah, I kind of can recall how that 6% come from. I mean, this is like a margin of safety. So it based on what? Based on what it come up with 6.5%.
Well, I think what he says is really the 10% is the pre-tax number, right? And again, when you look at 10% and you say like, okay, most of the time interest rates are below 10%, right? 10% are very, very high normal interest rates, right?
Yeah.
So if a company's trading at a 10% pre-tax earnings yield, and let's say interest rates are really, I don't know, 6, 7, 8%, something like that,
Yeah.
then you could take all the pre-tax earnings, issue enough debt, in theory at least, to buy, to equal to the market cap of the stock and still have money left over, right? And so, that's how Ben Graham defined margin of safety, right? And so I think when you look at Buffett, right, what Buffett really says is, he wants to buy in a business where it's giving him an appropriate yield, but also that yield gives him a significant margin of safety, right, where he's not going to lose any money.
Okay.
And so, and then, for him, he picked that number as 10%, sort of. Look, if interest rates were at 15%, I don't think he would say 10%, right? I think he's saying 10% because in most scenarios, interest rates are much less than 10%, right?
Usually it's a little bit higher than interest rate.
Huh?
A little bit higher than interest rate. That's the benchmark.
Yeah. So I mean, the funny thing is, right, and in 88, right, treasuries were at 9%. So 10% wasn't significantly higher than treasuries, right? And now, again, like I said, I think Buffett himself thought that interest rates were too high and were going to come down. So maybe Buffett thought interest rates should really be 6 or 7%, right? Which is where they did go to, right? And so if he's buying something at 10% and he thinks that interest rates should be like 6% or 7%, again, you're building in that, you can kind of feel a little bit comfort that you're buying with a margin of safety.
So as of today, the interest rate is much lower, so that earning yield should be lower than that.
Yeah, and you see that, right? PE multiples are much higher today than they were back in 88.
Okay, does it count a dividend yield into it? I mean, there's dividend, right? It's not talking about, let's say one stock with the same earning yield, and the other one has like a 2% dividend. The other one doesn't have it. So how does that, how do we take that one into account, the dividend effect?
The dividend?
Yeah.
I mean, really, the way I sort of think about it is if the company's paying a dividend and they're not earning very high returns, then, they should be paying it out as a dividend, right? If, in Coca-Cola's case, right, they were paying a dividend, but the business was actually earning really, really high returns, right? And so in some ways, you actually probably prefer them not to pay a dividend.
Yeah, what I'm
And
saying is that when he decided to purchase the stock, say 10% earning yield,
yeah,
so in fact he make decision, does he take into account the company dividend yield there? Or he doesn't even think about dividend, just look at the earning yield.
I don't think he thinks about the dividend, right? Because for him, it's like the earnings, whether they're retained by the company and reinvested or they're paid out to you, have at least the same value, if not more, right? If, like I said, if you can reinvest and retain the earnings, he probably wants the earnings to be retained and invested at high rates. But at the very least, if the company is earning high returns, you're kind of agnostic between whether they're paying out a dividend or not.
So in this case, when we decide to purchase price to purchase, dividend is irrelevant.
Yes, I think
Earning
so.
yield is really the one you need to look at it.
Correct.
Yeah.
David, I see your hands up.
Oh, yeah. Before I get to my question, I do want to make one point that Warren was on the board of directors of Coca-Cola from 1989 through 2006. So probably would have been a bad look for him to sell some shares of Coca-Cola while he was on the board of directors. Um, or probably make a very uncomfortable, meeting situation as well. Again, I don't think
Yeah,
that's
that's a good point. That's a good point.
yeah, but my question comes around to debt again. Like, so in the slide that you showed, the Coca-Cola company increased their debt a lot more between the mid 80s and the mid 90s. How do we take account into debt in like intrinsic value, or do we not? Or is it
Well,
just
I mean, in theory, like, look, if they had taken on, you know, if Coca-Cola was like a, I don't know, $15 billion company and they had $14 billion of debt, right? Like, that would be a very high, it would look almost like a leveraged buyout, right? That would be a very high amount of debt. And then at that point, you really kind of become very, maybe very concerned about, the risk of bankruptcy or stuff like that, right? But as long as your debt levels are not at that point where you really worry about the solvency of the business or the liquidity of the business, I kind of view it as just, as long as debt is prudent for the business, I really don't spend that much time looking at it, right? Because, it just gets captured in the interest expense, and which happens, when you're looking at pre-tax earnings or net income, right? It's already compensating for the interest that you're paying and stuff like that, right? What's interesting is even as Coca-Cola increased their debt, you know, their interest coverage ratio, I think the lowest it ever was 19 times, right? So basically saying that like, you know, their earnings would have their operating income would have had to fall like 95% before they would have ever had a problem paying their interest expense, right? So when you look at it from that perspective, right, there was almost no risk of Coca-Cola ever defaulting on their debt. And even as they increased their debt, right, their earnings were, their revenue, their operating income, was all growing at even faster rates, right? Like where you know I mean, if you remember the chart, basically between 87 and 92, they didn't really increase their debt that much. And the operating income increased about 15% a year. So operating income basically doubled, right? So, what was already a pretty healthy interest coverage ratio became even healthier over 5 years.
So when we're evaluating any company, so basically just the questions concerning debt is, can they cover the interest comfortably, hopefully? And then I guess the only other issue is like, can they just renew any debt covenants they have? Like if the repayment of the debt is due at a certain time, that they can just refinance the debt or get debt from another bank or something.
Yeah, and actually those two questions are kind of related, right? If you are easily making all your interest payments, then it's very easy for you to renew your debt,
Okay.
right? If you have a hard time making your debt, or your coverage is very thin, then the risk of you being able to refinance your debt is much more risky, right? But usually the companies, I think most of the companies that you guys are probably all looking at and things like that either have no debt or very, very little debt relative to the earnings that they have. And if you're looking at some of these special, like highly levered companies or something like that, that's where you have to be a little bit more careful. But most of the companies have not just enough earnings to pay the interest, but also they're generating enough income after interest to actually pay down debt over time. And that's most of the, when you're looking at companies in the S&P 500 or something like that, that's mostly what you'll see.
Thanks.
Yeah, Emil?
Hi, Jay. So in kind of like considering how like it's still a position for, that they still own Coca-Cola and Berkshire Hathaway still has it, is it potentially something to imagine that maybe, just maybe, they don't exactly view the holding as so much of a growth holding, or as much as it might just very well be a cash register for the dividend, given how many shares of it they actually have?
Yeah. I mean, I think now, now they're I think if I'm not mistaken, I think they make more in per year dividend than the original cost is of the stock, if I'm not mistaken. Um, I mean, I'm sure somebody can look it up very quickly. They own 400 million shares today. So I think if the dividend's over $2.50 per year, they're kind of recouping their cost basis every year in terms of dividend. But the question you're asking is, yeah, like, look, I don't think Coca-Cola is necessarily a growth company anymore, right? Or not the same as it was back at that time. But that's fine. It doesn't necessarily have to be. It's still it's still a growing company, and unless you had like really significant needs for cash, right? Like I think it's one of those things. It's like, well, why bother to sell it when I'm sitting on $350 billion of cash already? Like, I don't need this extra, you know, this extra, this extra cash for any other reason per se.
Just trying to understand how like it might have very well been one thing at one stage in their portfolio, but now it's a completely different thing in this stage of their portfolio.
Yeah, no, I agree. I think it's, definitely, listen, definitely when it was purchased, it was not purchased as like, hey, we just want to own it because it's a slow and steady company, right? Coca-Cola was a growth company, right? And it was, it was maybe a growth company that had kind of lost its way a little bit in the early 80s, early to mid 80s, and then kind of refound its way. And then it was really the combination of, hey, this is really an interesting growth company, combined with the fact that, like, hey, wait a minute, we can buy maybe one of the best businesses in the world at like a really very low valuation. And so I think it's the combination, because I think even before 88, I think anybody who'd studied Coca-Cola, and I'm sure Buffett had studied Coca-Cola before 88, like kind of understood what, the international growth opportunities and stuff like that. But interest rates were a lot higher in the 80s. and Coca-Cola was not as inexpensive, and then was probably oh, Joel just said Coca-Cola pays about a $2 dividend, so they're making about 800 million bucks a year, so close to their cost basis, or every 18 months they're recouping their original cost. Pretty nice. So it shows the power of really kind of investing for the very long term. But yeah, no, I agree. I think it probably has a very different role in their portfolio today. But it also just has a role of, okay, like I don't really have use for this capital, and so why not just stay invested in it until I can find something else that maybe makes more sense, if ever.
Okay, thank you.
MD.
About the growth, I see like Coca-Cola had unique growth, like in terms of the volume as well as the price. But what's your view that some business like they want to they increase the volume but reduce the price until the break even? Is that a good strategy, or those sort of company are reliable that they would be durable?
You're saying companies that reduce price?
Yes, reduce price to increase the volumes.
They reduce price to grow volume.
Yes.
Yeah. So look, there are examples of companies that are able to do that, right? People talk about Amazon or Costco or something like that is basically using their scale to try to lower their costs, and then passing on a good portion of that cost to the consumer, and then kind of that creates more demand for them, which helps them gain more scale, which helps them lower costs even further, and then kind of creating this virtuous cycle, right? um, you know I mean, so so it could, I think there's no one right or wrong way, right? It's just like what is the better, what is the way to do it, for your business, right? In the example of Amazon or Costco or something like that, right, where you're a retailer, right, and you're selling just a variety of goods, right, your ability to sell, and in reality, right, like you know I mean, I know, like, Amazon might sell, some of the same products and some different products and stuff like that, right? But you're basically selling the same products, or, similar products that, Walmart or somebody else would be able to sell, or, a consumer would be able to buy there. And so your ability to offer the lowest price, really matters for like a retail business, right? In the example of Coca-Cola, right, I think one of the things that Coca-Cola really learned after the cola wars is that there were consumers who were very much identify themselves as Coke drinkers or Pepsi drinkers, and when Coke changed the formula for New Coke, a lot of people revolted and asked for Coca-Cola Classic to come back. And so when you know that you have a unique product that people really enjoy and like, right? You might have the opposite, where you can continue to raise price because, just because you raise price doesn't mean that people are going to switch from Coca-Cola to Pepsi or something like that, because they view them as not identical products.
And about the model, like the Gordon model, one of the assumptions is that business will be durable perpetually. So, like, how do you make decision that this business is going to survive perpetually?
I mean, you don't know for sure, right? But you can kind of have like I mean, again, like that's the beauty of the way the markets are, right? Like if you change your mind, you can always sell your investment, right? But when you sit down and you look at it today, and you have to think about like what's happening in the world today and what the world maybe necessarily looks like and this and that, um, you know, you're trying to make an educated guess, right? But like I said, there are certain companies that even if you sit back and look at them today, you can clearly see like reasons why these businesses may not exist in the near future, right? A lot of traditional retailers, I think, are a good example, right? Because of like what we just talked about with Walmart and Amazon and Costco and stuff like that. Like they generally struggle, and it's hard to imagine that the struggle doesn't continue to get worse as some of their traditional, as some of these new retailers continue to get bigger and stronger, right? Um, you know, but again, like and this is what we were talking about before, like technology and stuff like that. Why is technology investing particularly hard? Because the future, even the near future, might not be very predictable, and things can change very quickly.
Do you
But
recommend certain
So-
industry? Sorry.
I was saying there's certain there's certain industries where you can look. I mean, you can look at some companies and just be like, look. I mean, even in 1982, right? Like I said, Coca-Cola had been around for almost 100 years at that point, right? So, sometimes the longer the company's been around, the greater the sense that it's going to continue to stay around, right? Because it's already been through a lot of challenges and stuff like that. I want to be sensitive to time. So Charles, I see your hands up again, and then let me just make sure I see a couple of things on the chat.
Yeah, I have a quick one.
Okay, go ahead.
Coca, they purchased the entertainment business. Usually, it's highly irrelevant, right? Usually, business they diversify like this, you feel like it's kind of risky. So they say I can diversify to do some better things, but usually you can just purchase Pepsi plus the Disney, right? As versus purchase Coca-Cola. So my question really is, a company they purchase highly irrelevant business, which means their core business is a kind of lack of growth, probably. That's why they purchase it. That's usually a bad sign. That's how I view it when they expand into the entertainment. How do you think about that one? I mean, it doesn't look like they're really declining, but the way they're doing is kind of suspicious, right?
Yeah, I mean that's why Peter Lynch, specifically calls it diversification, right? Like, you have these companies that have these very good core businesses, and then managements, because maybe the core business is a good business, but it's not really growing or something like that. They want to get into other businesses or for whatever reason, right? But usually, usually if you have a relatively good um, kind of core business, you don't really want to see the companies get into, adjacent businesses, especially if they don't make any sense.
But that's a
Right.
sign saying their core business is growing slower. That's what it is.
Well, I mean, not necessarily, right? I mean, in Coca-Cola's case, it wasn't necessarily that the core business was growing slower. It was really more that they were so exposed to international markets that they wanted to be more balanced between the international and the US at the time, right? Because they viewed it as, the international markets were going to struggle, and they were struggling, at that time versus the US. And I think at that point also there was a corporate fad of having conglomerates and being in lots of different businesses, and so they thought that their brand reputation and everything from Coca-Cola, the soft drinks company, could translate into other other industries. I remember them saying at one point, like, oh, now that we own Columbia Pictures, we'll put Coca-Cola in all the movies and we'll have product placement, and that'll be like another form of advertising and marketing and brand building and stuff like that. Sure, but was it really worth kind of the management distraction and everything else of being in a completely unrelated business that you don't necessarily understand, right? It's one
Yeah.
thing to sugar water. It's another thing to keep trying to make hit movies, which as hopefully you remember from from one of the readings, right? Even the people in the movie business were like, we can't predict which movies are going to do well and which ones are not going to do well. Again, because of time, MD, I see your hands up again, so I'll let you ask the last question, and then anybody else has questions, again, like I think I say at the end of every class, like, please send them through on email or Canvas or anything like that, and I'll make sure we leave a lot of time for questions that, after, next week for the last class. MD?
Yeah, my question is it was the first question, like, what are the factors you consider for choosing an index? So you mentioned a lot of factors. Actually, what you are trying to achieve with these factors, like for example, geography, currency, then industry, as well as different asset types. You mentioned a lot of factors. What are you trying to achieve?
What am I trying to achieve? You're asking me?
Yeah.
I mean, I'm just trying to achieve, sleeping well at night. So
No. Yes, I got it.
no, I'm not joking. I'm serious, right? Like, it all depends upon what you're looking for, right? If you're looking for maximizing your return, right? Maybe you want to be in more, high growth, like the NASDAQ or something like that. If you think like, tech is absolutely going to be, everything that people have promised it to be, but you'll have a lot more volatility, right? So it's kind of like I said, you have to balance out what you're trying to do. Some people, most people are very focused on making as much money as quickly as possible, and a lot of people are also focused on preserving capital and making returns for the long term. So I'd say the one thing that the finance industry is great at is they're great at creating a product for every type of person. And, so every person, like I said, there's, the funny thing is there's more ETFs now than there are stocks, right? So you can find almost every type of, people have sliced and diced it every way possible. There's ETFs of Bitcoin now, right? There's ETFs of the S&P 500. So you can find whatever, index passive vehicle you want to find and invest in it. So, like I said, it comes down to what you think makes sense, right? But like, I don't, I mean, again, I don't think there's a one size fits all answer that I think you're looking for, right? I think it really comes down to what your own personal goals are, right? And this is where I said, like, this isn't a personal finance class, but you should definitely talk to a financial advisor if you feel like you need to, and understand like what your personal investment goals are, and then they can help you find those types of investments that might make sense.
So what is the good side and bad side of the S&P 500?
I mean, I think the good side of it is you have some of the best companies in the world, and probably one of the best capitalist economic systems in the world, right? So that's why I think these companies do well. The bad part about it might be that it's just becoming a very concentrated index, right? Meaning, the tech companies are becoming so big and so dominant that if something ever happens to tech, right? If we wake up tomorrow and people stop using their iPhones and they stop shopping at Amazon, and AI is not what people think it's going to become or whatever, right? A lot of these stocks will go down, and because they're such a big part of the index, it's going to move the index a lot.
So which index is balance and steady growth has, in your opinion?
I mean, look, there's, like I said, there's an equal weighted S&P index. So you can buy the companies, but instead of owning them by their market cap weighting, you can own like 1/500th of every company. So you could argue that that's more balanced. But, the funny thing about capitalism is it's not like, sometimes the best companies continue to do really well. So, the S&P 500 has outperformed the equal weighted S&P 500 because we were talking about this in one of the classes, but the larger companies do continue to do well, maybe because of the way tech is, or maybe it's because larger companies can reinvest more into bigger and bigger investments. So But again, like I said, you can spend a lot of time. There's lots of research on all the different indices out there, and you can kind of figure out like how the different indices are created, or different types of industries or geographies or companies that are in different benchmarks. So, again, I just want to be sensitive to everyone's time. So thank you guys. I look forward to our last class next week. Again, send in all the questions. I'll definitely try to answer them all before class. And let's just have a good rest of the week, and we'll talk again next week. Okay.
Thank you very much, Jay.
Okay. Bye.